Chapter 13, which is dealing with the accounting process particulars for corporations. So the first example that we will look at is dealing with the issuance of stock, both par value stock, stated value stock, and no par stock issuance. Rodriguez Corporation issues 19,000 shares of its common stock for $152,000 cash on February the 20th. And so what we'll do is we will prepare the journal entries to record this event under each of the following separate situations. So the first example will be selling the stock at a $2 par value. And so to do that, you would record a debit to cash in the amount of $152,000 because that's the amount of cash that Rodriguez Corporation is receiving. And then we would credit common stock, $2 par value. And so that for $38,000, and we figure out that it's $38,000 by taking the number of shares that we are issuing, which is 19,000, multiplying that by the par value, which in this case is $2. Then we would then credit the paid-in capital in excess of par value common stock for the remaining amount. And so in this case, it's $114,000. We get that by taking the $152,000, subtract 38, and then what's left is what is paid in capital in excess of par value. So the next scenario that we will do is we will sell the stock has neither a par or a stated value. And so this would be the simplest scenario is we would debit cash in the amount of $152,000 because we're receiving cash as a corporation from our investors to purchase the stock. And then we would credit common stock, no par value for $152,000. The third example would be if we sell a stock at a stated value. And so in this case, the Rodriguez company is selling 19,000 shares of stock with a $5 stated value. So we would debit cash in the amount of $152,000. Again, that's the amount of cash that Rodriguez company is receiving. We would then go ahead and have to credit the common stock $5 stated value for $95,000. And again, we calculate that $95,000 by taking the number of shares multiplied by the stated value. And so in this case, 19,000 shares times $5 is $95,000. Then we would have to also then credit paid in capital in excess of stated value common stock for $57,000. So again, we get the $57,000 by taking the 152, subtract 95,000, we get 57,000. Remember that your debits always have to equal your credits, and that's one way that you can check, make sure that you're doing this correctly. How do we go about recording stock issuances? Similar to what we looked at previous, but again, we're going to get into a little bit more detail here as well. So we're going to prepare the journal entries to record the following 4 separate issuances of stock. And so the first transaction would be when a corporation issues 4,000 shares of $5 par value common stock for $35,000 in cash. And so we would have a debit to cash in the amount of $35,000 because that is the amount that the corporation is receiving. We would credit common stock $5 par value by $20,000 because again, we're issuing 4,000 shares multiplied by the $5 par value per share is $20,000. And then we would credit the paid in capital in excess of the par value of common stock for $15,000. Again, take 35, subtract 20 from it, you're going to have 15,000 left. And so that would be the paid in capital in excess of the par value. Now, number 2 is a corporation that is issuing 2,000 shares of non-par common stock to its promoters in exchange for their efforts, estimated to be worth $40,000. The stock has a $1 per share stated value. And so what we would do there is we would debit the organization expenses for $40,000 because we are paying the promoters that helped us to form our corporation and help us to sell the stock. We are paying them, so we have to record the expense. It would be organization expenses debit for $40,000. And then we would have to credit the common stock, which is a $1 stated value for $2,000. And again, we figure that out by taking the number of shares multiplied by the stated value. And then we would also credit the paid-in capital in excess of stated value common stock, $38,000. So again, you take 40 minus 2,000 from it, you get 38,000. And that's the paid-in capital in excess. Now let's look at scenario number 3. A corporation issues 2,000 shares of non-par common stock to its promoters in exchange for their efforts, estimated at 40,000, but now this time the stock has no stated value. So in part 2 of this, the stock had a $1 stated per share stated value. So now what we're going to do now is the stock has no stated value. So then what we would do simply is we would take and we would debit the organization expenses, 40,000, and then we would credit the common stock no par value for 40,000. And then finally, we'll look at number 4, which is when a corporation issues 1,000 shares of $50 par value preferred stock for $60,000 in cash. And so what we would do is we would have a cash debit in the amount of $60,000. We would credit the preferred stock $50 par value. And so again, 1,000 shares multiplied by 50 is 50,000. So we would credit that for 50,000, and then we would credit the paid-in capital in excess of par value on preferred stock. We would credit that 10,000. Remember that you can receive either cash for the issuance of stock in exchange for stock, or you can receive non-cash assets in exchange for stock. And so now we're going to look at what we would do if we issue stock for receiving non-cash assets. Sudoku Company issues 7,000 shares of $7 par value common stock in exchange for land and a building. The land is valued at $45,000. The building is valued at $85,000. So we'll prepare the journal entry to record the issuance of the stock in exchange for the land and the building. And so we would debit land in the amount of $45,000. We would debit building in the amount of $85,000, because again, it's based on the values of those two. Okay. Then we would credit common stock $7 par value. So again, 7,000 shares by $7 is 49,000. Then we would credit the paid-in capital in excess of par value common stock for 81,000. So again, you take the total for the land and the buildings, subtract the 49,000, and then which is the par value for the stock, and that's going to give you the additional in excess paid-in capital. How do we issue a large stock dividend? On June the 30th, Sharper Corporation stockholders' equity section of its balance sheet appears as follows before any stock dividend or split takes place. Sharper declares and immediately distributes a 50% stock dividend. After the distribution is made, we're going to prepare the updated stockholders' equity section and compute the number of shares that now are outstanding. And so what this is companies can issue either a cash dividend where they're paying cash to their investors, or they can issue more stock as a dividend, issue stock as a dividend. And so That's what we're going to look at here. So the first part is we need to identify the number of shares that are outstanding. And so it's 50,000. And we can figure that out because we look at this 500,000 right here, divide that by $10 par. And actually they tell you here too. That would give you 50,000, but they also tell you here as well. Then you could identify the stock dividend percentage. We said it would be 50%. And so we'll compute the number of new shares. So we'll take the number that's in step 1 multiplied by the number in step 2. That's going to be 25,000 new shares that the company is going to distribute. And then we'll have to determine the value that the new shares have at market, a small stock dividend, or par for large stock dividend. So in this case, it's going to be based upon the par value. And we said the par value is $10. So each share is going to be worth $10. And then we'll determine the amount to be capitalized or debited to the retained earnings account. So we figure that out by taking and multiplying steps 3 by step 4. And so it's going to be $250,000. And then if we look at this, we have before the stock dividend for this share, stockholders' equity, and then upon the stock dividend. So the common stock would then be an additional 250,000, and then you would have to reduce the amount of retained earnings by 250,000. Doesn't affect the stockholders' equity at all. And then it's going to add to the number of common shares. So if we just carry this over, we see that we take 500,000, we add 250 to it, we're going to have $750,000 in common stock at $10 par value. Our paid-in capital in excess of par value is going to remain the same. And so if we add up both of those, it's going to be 950,000. And then if we take our retained earnings, 660,000, subtract 250,000, we're going to have 410,000 remaining in our retained earnings. So if we take the paid-in capital, 950,000, add 410,000, we're still going to have the same shareholders' equity of $1,360,000. And then our number of common shares that are outstanding, we take 50,000, we add 25,000 to it, we're going to have 75,000 after, because again, we're issuing more shares, so we're going to have 25,000 more shares outstanding. So now what we're going to look at is, that was the first one here. This would have been based upon, this is based upon a stock dividend. Okay, so this, remember, this is based upon a stock dividend. Now we're going to look at something different. So we're going to have something similar, but this time what they're doing is they're going to be doing a stock split. On June the 30th, the Sharper Corporation's stockholders' equity section of its balance sheet appears as follows before any dividend or split. Now, Sharper declares and immediately distributes a 3-for-2 stock split. So after the distribution is made, we're going to prepare the updated stockholders' equity section and compute the number of shares that are outstanding. So again, we want to figure out how many shares we're going to have after the split. So initially, right now outstanding, we have 50,000 shares outstanding, multiplied by the split ratio, which is 3-to-2. And then we can compute the number of shares outstanding, which would be 75,000. So we could multiply 50,000 by 3-to-2. That's going to give you 75,000 shares that would be outstanding after the split. So the par value of the shares after the split is still going to be, before the split's $10 multiplied by the reciprocal of the stock split, which is 2 to 3, then the new amount for the par value of the shares after the split would be $6.67. So remember, we're issuing more stock. The investors get more stock, but the value of that stock then would get reduced. I should say the value for each share would be reduced. So companies often will do stock splits when their share price gets high enough. Then they will often do a stock split in order to be able to keep the price of their stock consistent, and it works out the same for the investors. The investors still hold the same amount that they had previous, because in total, the total obviously that they hold stays the same. So then we see then that it's going to be, again, we see then, even though we're changing that it's a 667 par value, it's still going to be the same, and then the amount of shares is going to increase. Do is look at how we would calculate a small stock dividend. Stockholders' equity of TVX company at the beginning of the day on February the 5th is as follows. So they had, and so on February the 5th, the directors declare a 20% stock dividend distributable on February the 25th to the February the 15th stockholders of record. The stock market value is $40 per share on February the 5th before the stock dividend. So we're going to prepare the entries to record both the dividend declaration and its distribution. So the first step in valuing the stock dividend is to identify the number of shares outstanding. We see that we have 60,000 shares outstanding. Then we'll identify the dividend percentage, which we said was 20%. Impute the number of new shares. Take 60,000 multiplied by 20% is going to be 12,000 new shares that will be done. And so we will have to figure out the value of the new shares at the market value. Again, since this is a small stock dividend, we're going to have to do it on the market value. And so we can go on look that up on the internet and find out how much the market price was for that day. And we see that it's $40. And then we determine the amount to be capitalized to the retained earnings. And so we take 12,000 multiplied by 40 is $480,000. Then first of all, then our journal entry to record both the declaration and the distribution. The first would be the declaration of the stock dividend. And so we would have retained earnings, which would be 60,000 outstanding shares multiplied by 20% equals 12,000 shares by a $40 market of $480. And then we have the liability for the common stock dividend distributable. So again, 12,000 shares at $10 par is 120,000, and then the paid in capital in excess of par and common stock is 360. So again, you figure out the amount of the common stock dividend distributable by the 12,000 shares, new shares that will be distributed, multiplied by the par value, which is $10. And then to figure out the excess paid in capital would be, you take the amount, the value of the shares, which in this case is 480,000. You would take that, subtract 120,000 from it, you're going to get 360,000. So then we have to then record the actual distribution. So in order to do that, we would then debit the common stock dividends distributable for 120,000. Again, you can see how we calculate that. And then we would debit the common stock $10 par value. So 12,000 shares by $10 par value is 120. Now that we've made those journal entries, we will prepare the stockholders' equity section of the balance sheet after the stock dividend is distributed. And we're going to assume that there were no other changes to equity. We see here that they are issuing another $120,000 of common stock. And then the paid-in capital in excess of par is $360,000. We get that again from our journal entries up here. So the total paid-in capital addition is $480,000. And then that would reduce the retained earnings by $480,000. And so then it doesn't change the total stockholders' equity at all. And then we have 12,000 more shares outstanding. And again, it doesn't change this because we see that the paid-in capital is 480, and then we're reducing our earnings by that. So it's zero. So then we see here that after the stock dividend, we now have 720,000 of common stock issued. We have 785,000 of paid-in capital in excess of par value. Then we have the total paid-in capital now of $1,505,000. Retained earnings is 70,000 because we take 550,000, subtract 480,000 from it is 70. And then our total stockholders' equity, that would remain the same. And in the number of shares outstanding, you would take 60,000, add 12,000 to it. So then the total number of shares outstanding would be 72,000. Paying dividends on non-cumulative preferred stock. The York's outstanding stock consists of 80,000 shares of non-cumulative 7.5% preferred stock with a $5 par value, and also 200,000 shares of common stock with a $1 par value. During its first 4 years of operation, the corporation declared and paid the following total cash dividends. So we're going to determine the amount of dividends paid each year to each of the two classes of shareholders, both preferred shareholders and common stockholders. Also compute the total dividends paid for each class for the 4 years combined. What we can do is the annual preferred dividend is a $5 par value for a preferred share. The dividend rate 7.5%. And so the dividend per share is 37.5 cents. And so the number of preferred shares is 80,000. And so the preferred dividend then is 30,000, because you take the par value and you multiply that by the dividend rate. That gives you the dividend per preferred share. And so if you take that multiplied by the number of preferred shares, that should give you the preferred dividend. And so we see here that in the first year in 15, the preferred, they had a $20,000 cash dividend. Preferred, they get paid first, and so they should have gotten 30,000, but they didn't. They only got 20,000, and then they didn't have anything left over in order to pay common. In 16, they had 28,000 of dividends, and so 28,000 again, it's still not the 30, so then that whole amount was paid to the preferred stockholders. The common stockholders didn't get any. Then we see here we had $200,000 cash dividend that was paid, and so the preferred stockholders all got 30,000 in total, and then the remainder would have been paid to common. And then in 2018, they had 350,000. Again, 30,000 of that would have been paid to common. The remainder would have been, or preferred, the remainder would have been paid to common. And so we could just add up everything. So that, now that, remember, is for a non-cumulative. So now what we're going to do, okay, so remember this is non-cumulative. And what that means is that they're going to pay, to the preferred obviously first, but if the preferred doesn't get paid the entirety of their preferred dividend, they just simply don't get it. So the next one we're going to take a look at would be a dividend, but it would be for a cumulative preferred stock. So again, the same amounts, but but again, remember, this is going to be for a cumulative. So this portion here, the annual preferred dividend, that's going to be calculated the exact same way, regardless. But notice here, so the total cash dividend that would be paid in 2015 is $20,000, and all of that would be paid to the preferred. Common would not get any, but that's going to put us in arrears of $10,000 because we still owe this is a cumulative preferred stock this time. We still owe our preferred stockholders $10,000. We figure that out by taking 30,000 multiplied by the 20 that they received. 30,000 is the preferred dividend minus the amount that they received, gives us the amount of dividends that are in arrears. And so then in 2016, we see here that now we declared a $28,000 dividend. So we take that, we would pay all of that to the preferred. Common still is not going to get anything because again, we're still not at that 30,000 preferred dividend. So the preferred are going to get everything. And so then we're adding to it now because we have $2,000 in arrears for 16. We also have 10,000 in arrears now for 15. So we take 60,000 subtract from the 48. So you take, they were owed 60,000 now total for the preferred minus the amount that they've received, which is 48. And that's going to get the amount of dividends that are in arrears. So then in 2017, look, we declare a dividend of $200,000. Well, now the preferred, out of that, the preferred then would get 42,000. And then the common would get 158. And now we've now paid off the arrears. The reason for that is we're going to take the 30,000. They're going to be able to get that first. They're also there's enough dividends declared that we're able to clear up the arrearage. So then the preferred then gets a total of 42,000, and then the common then would get the remaining amount of dividends that we declared. And then we see here now that in 2018, we see that we had a total cash dividend declared of 350,000. This time, our preferred stockholders would then get 30,000 of that because that's the amount that they're due. And then our common stockholders then would get the remainder, which is 320,000. And then of course, we don't have an arrearage then for our preferred stockholders. And so then we can just add those up and we can see then the total amount of dividends that were paid for each year or each type. So the total dividends that were declared, the amount that the preferred stockholders received, the amount that the common stockholders received. We're going to look at recording and reporting treasury stock. This is when the company purchases stock of their own company. And so on October the 10th, the stockholders' equity of Sherman Systems appears as follows. So that's shown right here. So the first thing we need to do is we were going to prepare the journal entries to record the following transactions for Sherman Systems. So on October the 11th, we purchased 5,000 shares of its own common stock at $25 cash per share. So we have treasury stock common, and again, 5,000 shares at $25 a share. Debit is 125,000. We would credit cash 125,000. And then on November the 1st, we sell 1,000 treasury shares for $31 cash per share. So we have a debit to cash, the amount of 31,000. So again, that's 1,000 shares multiplied by the amount that we sold them per share, in this case $31,000. Then we have the treasury stock common, which is the amount that we purchased them for, which is 25 a share. So you have 25,000 shares by $25 a share is $25,000, so credit. And we also would credit the paid in capital for the treasury stock of 6,000. And then on November 25th, we would sell all of the remaining treasury shares for $20 cash per share. And so on November the 25th, we had a debit to cash in the amount of 80,000. Again, 4,000 shares multiplied by the 20,000, which is what we sold them for. We also then have to debit the paid in capital treasury stock for 6,000, because that is the difference of that versus the price that we originally paid for it, which is that. Then we also have the retained earnings of $14,000 debit. And then we would credit the treasury stock common 4,000 shares at 25 by 100,000. Which is the amount that we purchased them for. So now we're going to prepare the stockholders' equity section after the October the 1st stock purchase. So we have less the treasury stock in the amount of 5,000 shares at 25 is 125. So then we would take that, we would subtract that from the total. Then that would give the total stockholders' equity of $1,675,000. Look at preparing the statement of retained earnings. Following information is available for Amos Company for the year ended December 31st. So we'll prepare the statement of retained earnings for Amos Company. So the first thing is the beginning retained earnings balance of $1,375,000. We can just look and get that. And in the prior period adjustments, and then we have the depreciation expense net of tax of $55,000. We see that right here because it's restating because it forgot to record the expense. So now we have to record it now. And so that adjusts the retained earnings balance now beginning to $1,319,500, because we take the beginning balance minus the depreciation net of tax that we forgot in the prior year. That gives us then the adjusted beginning retained earnings. Then we add the net income for the year, which in this case is $126,000, less the cash dividends that were declared and paid of $43,000. And so the ending retained earnings, so you take the adjusted beginning retained earnings of $1,319,500. You would add to that the net income for the year of $126,000, and then you would subtract the dividends paid of $43,000. So that then gives the ending retained earnings of $1,402,500. How do we calculate the earnings per share or the EPS? Eckert Company reports $2,700,000 of net income and declares $388,020 of cash dividends on its preferred stock for the year. At year end, the company had 678,000 weighted average shares of common stock. So what is the amount of net income is available to common stockholders? So we have net income of $2,700,000. We would less the preferred dividends that we paid of $388,020. Gives us the income that's available to the common stockholders then of $2,311,980. And so to figure out the company's earnings per share, we have to take the income available to common stockholders of $2,311,980 and divide that by the weighted average shares, which in this case is 678,000. So that gives us the basic EPS or earnings per share of $3.41. So the Kelly Company reports 960,000 of net income and declares 120,000 of cash dividends on its preferred stock for the year. At year end, the company had 400,000 weighted average shares available. So first of all, figuring out the net income available to common stockholders. So the net income we have is $960,000 minus the preferred dividend of 120,000. So that leaves an income available to common stockholders of 840,000. So then again, to figure out the basic earnings per share, we have the income available to common stockholders divided by the weighted average shares. So 840,000 divided by 400,000 average shares, we get a basic EPS of $2.10 a share is the price earnings ratio. So we're going to compute the price earnings ratio for each of these 4 separate companies. So again, remember that the price earnings ratio is the market value per share divided by the earnings per share. So you can look up the market value through various quotation services. And then the earnings per share, you can look that up, or you can calculate it like we did previous. So for Hilton, you have the market value per share of $176.40, and then you'll divide that by the earnings per share. And so that's going to give the price earnings ratio of 14.7. For SPG, you have $96, which is the market value per share, divided by $10. Earnings per share is 9.6 is the price earnings ratio. Then for Hyatt, you have a market value per share of $93.75 divided by the earnings per share of $7.50 gives you a price earnings ratio of $12.05, or excuse me, 12.5. Again, it's a ratio. This isn't dollars, it's a ratio. So 12.5, excuse me. And then the for Accor, you have the $250 of the market, that's the market value per share, divided by the earnings per share of 50. That gives a price earnings ratio for Accor of 5. So now, which one of these 4 companies does the market have the lowest expectation of future performance? So of the stocks above, the market has the lowest expectation of future performance for Accor. This is because Accor has the lowest PE ratio of 5. So even though Accor has a high earnings per share, the market has the lowest expectation of future performance for Accor. Is we will calculate the dividend yield. To calculate that, it is the annual cash dividend per share divided by the market value per share. And so for the first company, company number 1, the annual cash dividend per share is $13. Divide that by the market value per share of $168.83. That gives us a dividend yield of 7.7%. We can do the same thing then for company number 2. So we have $10 of annual cash dividend per share divided by the market value per share gives us a dividend yield of 9.2. And we can do the same thing for company number 3. And finally, company number 4. Now, which company's stock would probably not be classified as an income stock? The yield of 1.9 on stock number 4 is significantly low, is sufficiently low that it probably would be classified as a growth stock, not an income stock. Note that classification involves expectations, not necessarily realization. So it's because this one has a really low dividend yield. And we'll look at the book value per share. The equity section of Cibral Corporation's balance sheet is shown as follows. So we're going to determine the book value per share of the preferred and common stock under two separate situations. So first of all, looking at them having no preferred dividends in arrears. So we see that they have total stockholders' equity of $1,585,000 less the equity applicable to preferred shares. And so they said they had preferred stock of 250,000. And again, we don't have any dividends in arrears. So we'd take 250,000, would subtract that from the total stockholders' equity of 1,585,000. That gives us the equity applicable to common shares of 1,335,000. And then we would take the book value of the preferred stock, which is $250,000 divided by the number of shares outstanding, gives us $25 par value. And in the book value, and in the book value of the common stock is 1,335,000 divided by the number of shares outstanding, 100,000, gives us $13.35 book value per share of common stock. We'll look at this again, but this would be if they have 3 years of dividends in arrears. So the annual preferred dividend for the par, so remember the par value of the stock is $25. The dividend is 6%, so 6% of 25 is $1.50 is a dividend per preferred share. And so the number of preferred shares that were issued and outstanding is 10,000. And so the annual preferred dividend is 15,000. The number of years in arrears is 3. So each year they have $15,000 in arrears in this example. So the total amount of dividends in arrears is 45,000. So then we would take the total stockholders' equity of 1,585,000 less the equity applicable to preferred shares, which again is 250,000. And we have to take the cumulative dividends in arrears, which is 45,000. So we would add both of those. We come out with 295,000. And in the equity applicable to common shares, we would take 1,585,000, subtract 295,000 from it. So the equity applicable to common shares is $1,290,000. And so the book value of preferred shares then you take is the 295,000 divided by the 10,000 shares is $29.50. And then the book value of common stock, so you take 1,290,000 divided by 100,000 shares is $12.90. Is cash dividends, treasury stock, and settlement of retained earnings. Alexander Corporation reports the following components of stockholders' equity on December 31st of 2016. And then in the year 2017, the following transactions affected its stockholders' equity accounts. So we're going to prepare the journal entries then for each. So the first transaction on January the 2nd is purchasing 3,000 shares of its own stock, so purchasing treasury stock at $25 cash per share. So you have treasury stock common, 300,000 multiplied by 25. We have a debit of 75,000. Then we would credit cash 75,000. And then on January the 7th, the directors declared a $1.50 per share cash dividend payable on February the 28th for the February the 9th stockholders of record. So we see here that on, first of all, we have to declare the dividend and then we have to pay the dividend. And what we do, so again, the directors, they decided to pay a cash dividend. So you would have retained earnings, you would debit that 40,000 and 40,500 because you take the number of shares outstanding multiplied by the amount of dividends that you're declaring. So in this case, per share. So in this case, 40,500 debit to retained earnings. Then we would credit to the common dividends payable of $40,500. Then when we go to actually pay the dividends, so this creates the liability declaring the dividends. Now we're actually going to pay the dividends on February the 28th. So in order to actually pay the dividends, we would debit the common dividends payable, $75,000, and then we would credit cash in the amount of $75,000. They must have had some dividends previously that were previously declared that they needed to pay as well. On July the 9th, we sold $1,200 of treasury stock for $30 in cash. So we per share. So we would have cash, the amount of 36,000 debit, which is 1,200 shares multiplied by $30 a share. They would credit to treasury stock for the amount that we originally paid. So 12,000 shares by 25 is 30,000, and then the paid in capital treasury stock credit of 6,000. And then on August 27th, we sold 1,500 of the treasury stock shares for $20 cash. So in this case, we would have cash in the amount of 30,000 because 1,500 shares multiplied by $20 a share. Paid in capital treasury stock is 6,000, and then the retained earnings 1,500, and then we would credit the treasury stock common for 37,500. And then on September, so on September the 9th, we're going to declare a dividend. So directors declared a $2 per share cash dividend payable on October the 22nd to the September 23rd stockholders of record. So again, we have retained earnings, the amount of 59,400. So we have 29,700 shares multiplied by $2 a share dividend. So it comes out to 59,400. So we debit that. We'll credit the common dividend payable for 59,400. And then on October the 22nd, we actually pay it. So we have common dividend payable of debit of 59,400. That clears the liability. And then we have cash then credit of 59,400 to show the cash outflow. And then finally, to close out our books then for the year and to close out the $52,000 credit balance from net income in the income summary to the retained earnings. We would have a debit to income summary, an amount of 52,000, because it has a credit balance in there now for income summary. We want to close it, so we'd do the opposite. We would debit it, and then we would go ahead and credit the retained earnings for 52,000. Then we could prepare the statement of retained earnings for the year ended December 31st of 2017. So we have retained earnings on December 31st of 16 of 340,000. We add our net income from the current year, which is 17 of 52,000. That gives us 392,000, and then we can subtract the cash dividends that were declared of 99,900. And then we had less the treasury stock reissuances of 1,500, gives us the new retained earnings for December 31st of 17 of 290,600. And then we can prepare the stockholder equity section of the balance sheet. So we have a common stock, $25 par value, 50,000 shares authorized, 30,000 issued. We're looking at the number outstanding was 29,700. So you take 29,700, multiply by the 25, the par value, and that gets you that amount. And then the paid in capital in excess of par is 50,000, and you can get that from up here. So the retained earnings then of 290,000 from the statement of retained earnings. So that gives you $1,090,600. And then you less the treasury stock that we currently have still of 300 shares at $25 cost is 7,500. So then that gives stockholders equity then of 1,083,100.